Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 30.14%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return now of 19.58%. We also have a technology portfolio which has an annualized return of 27.51%. And within that tech stock portfolio, if you only invest in the companies that pay dividends, your return would be even higher. And like in last week's video, later in the video I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. Now this week, the S&P 500 fell for the second consecutive week, this time falling 1.39%. Previous to that, the S&P 500 was up for 6 consecutive weeks, so it was due for a break. Our dividend growth portfolio this week beat the market's 1.39% loss, but alas, it also pulled back with a 0.69% loss. Meanwhile, our high yield stock portfolio continues to defy my expectations by eking out a small gain this week, despite the market pullback. On the other hand, our technology portfolio continued its volatile ways as it got crushed this week, falling 5.5%. However, since its inception, it's still beating the S&P 500, but the volatility has been extreme, like last week showed. Overall, it was an unusually good October for the stock market, which historically does poorly during presidential election years. Next week is critical as we have the election and then the FOMC meeting, which will go a long way in determining if there will be more interest rate cuts. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,532 after 148 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so we are buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks did not do well, and neither did bonds. As you can see, our portfolio had overall losses where the blue line falls under the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April of this year, but had been the best performing portfolio over that time until last week. It has also been very volatile. And for those that have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our website, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing, and so they can follow along. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,532. The portfolio's return has been 19.58% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and the preceding year, the portfolio once again beat the market. There's no guarantee it's going to continue to beat the market, but it's a good start. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed at the same time. The high yield portfolio was started in August of 2023, and the annualized return so far is 30.14%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 22.75%. Make that 22.03% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for nearly 15 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return, which has existed for a lot longer. This slide shows the cumulative growth of the dividends we have received in our dividend growth stock portfolio. Our dividends for the latest month increased 54% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom dividend portfolios only invest in dividend-paying stocks that increase their dividend recently. And even in our newer technology portfolio, which invests in both dividend-paying and non-dividend-paying stocks, so far the dividend-paying tech stocks are outperforming the non-dividend-paying tech stocks. And along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that grow their dividend, in other words, they raise their dividends, or companies that start their dividends, in other words, they initiate a dividend, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, of course, the S&P 500 has dividend payers and non-dividend payers. So a better comparison is the dividend payers versus non-dividend paying. So that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay a dividend by 116.7%. Now the holy grail of dividend investing is having a stock portfolio that produces 1, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. That means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payment to bondholders. Here are 2 examples of stocks growing their dividend payouts over the years. The first is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 8.21%, and that's just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. Hopefully right up in the fourth quarter that's coming up. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in quality dividend growth companies. Now, my second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents per year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield is, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $61,625 of tax-free income. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. And then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I want to show my accounting students that you don't need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in my class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, would need to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invests an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our classroom dividend-growth stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund, also called an ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our two dividend-paying stock portfolios. As of today, our dividend-growth classroom stock portfolio's annual return is 19.58%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 11.6%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there is no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps, and that's a bad thing. Now, this slide shows our best performing stocks based on when they were initially purchased. This includes all four of our portfolios now, but as you can see in the upper right, the dividend growth stock portfolio was started much earlier than the other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by a dividend growth stock portfolio, at least for the time being. For example, our tech stock portfolio was our best performing portfolio on an annual basis up until last week. But because it has only existed since April of this year, none of that portfolio's stocks have made the list yet. Our best performing portfolio thus far on a per year basis is the high yield portfolio, but it only has two stocks on the list so far because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks than our dividend growth portfolio. Stocks in yellow, such as Evercore, F&G Annuities, and Repositrac, have been sold. So our best performing stock so far has been Evercore, which we sold recently. It provided us with a 252.9% return in a little over 2 years. Broadcom, a chip maker, remains at number 2 with a 204.7% total return since its initial purchase. Both it and Evercore have total returns over 200%, which means their initial investment has tripled. So far, 2 stocks have tripled and 5 stocks have doubled their initial investment, with Repositrac barely missing that mark. The fastest risers that are still in the portfolio are NVIDIA in our technology-themed portfolio with a total return of 181.2% in 10 months, and Tapestry with a 69.8% gain in 13 months. Bank of New York Mellon is on the list twice because it's in both our dividend growth stock portfolio and our high yield stock portfolio. Remember that total return includes both the dividends the company has paid as well as the increase in the stock price. This slide shows our best performing dividend stocks last week for the dividend growth portfolio. It does not include dividends paid that week. Despite the market falling this week, we had a few very good performers. They include Papa John's at 8.3%, Crane Holdings, Albemarle, Bristol Myers Squibb, and Trinet, amongst others. And this slide shows our best performing dividend stocks last week for our high yield stock portfolio. Remember, that portfolio has far fewer holdings than our dividend growth portfolio. The best performers were AbbVie and Papa John's, rising over 8% last week. Entergy and Bristol Myers also did well, despite the market going down. Before we look at the 10 stocks we bought this week, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow, like Fidelity, National, and Devon Energy, have been sold. On the left side of the screen are the 10 dividend growth stocks we bought a year ago. Stocks in yellow have been sold, like I said. American Express has been the best performer so far, with a 92.6% total return in a year. The average return of the 10 dividend growth stocks on the left that we bought a year ago is 35.49%, with Fidelity National being held for less than a year. The annualized return of all 10 dividend growth purchases is 37.93%. On the right side of the table, or the slide, are the 8 purchases we made for our high yield stock portfolio. It utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock, with Morgan Stanley and Fidelity National being examples of that. The average return of the high yield stock purchases we made or we bought a year ago is 41.54%, despite 3 of the purchases not being held the full year. The annualized return for all the high yield purchases is 52.18%. Obviously, our purchases won't continue that high of a return, but it's a great start for this portfolio. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. On this slide, we would list the stocks we sold, but we sold no stocks last week. Now let's talk about the dividend-growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week, but we only buy 10 per week. We purchase first 10 stocks on a list that are not in yellow. Stocks in yellow, in this case Microsoft, have already grown to be 4% or more of the portfolio, so we did not invest more in them this week, or I should say last week, because we want to build a more diversified, less risky portfolio. Last Monday, Bristol Myers was our top-rated stock, which is nice since it turned out to be one of our best performers last week. Making the list once again was Thermo Fisher and McKesson. Remember, we use many criteria to filter out stocks. And if a stock is hovering at the required level, in other words, being really close to that level to be filtered out, they can make the list one week and then drop off the list the next week based on a very small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which change frequently. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and the total of the proceeds for any sale, if we made a sale that week, and split it up amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we were purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but I think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Applied Materials, HF Sinclair, Merck, KLA Tencor, Nike, PNC Financial, and Qualcomm. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. It's not a high yield strategy. The stocks with the highest yields last week were, in order, HF Sinclair, Bristol Myers, PNC Financial, and Merck. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks on the next few slides, and some of the tech stocks. This week, I purchased over $3,100 of the stocks from the dividend growth portfolio, high yield portfolio, and tech portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF, which was, as I mentioned, SCHD, and I buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the returns with you as I have enough data. On this slide, I wanted to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they tend to be smaller companies, but studies have shown they historically beat the market averages by a significant amount. An example of that would be F&G Annuities and Repositrac, back on the slide of the best performers. We do not buy any under-the-radar dividend payers this week or last week. All the stocks we bought this last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component on the slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. This is the hardest one to calculate. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, West Pharmaceuticals, and Nike. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials, Lam Research, Thermo Fisher, Microsoft, and West Pharmaceuticals. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Bristol-Myers, Lam Research, HF Sinclair, Lamb Weston, and PNC Financial. All these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Bristol-Myers, Applied Materials, Lam Research, Thermo Fisher, McKesson, Microsoft, West Pharmaceuticals, and KLA-Tencor. These earned a B or better grade. The companies with the best combination of recent dividend increases, current yield, and potential of future dividend increases are Bristol-Myers, Applied Materials, Lam Research, and McKesson. Here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that we had recently received, plus proceeds from any sale that we may have made that week, which were none last week. We didn't make any sales. And then invested the total in the top 10 stocks in our buy list on the previous slides, as long as they don't have a portfolio allocation of 4% or greater, such as Microsoft. Sometimes instead of dividing evenly across all 10 stocks, I try to invest a bit more into the high-ranked stocks, and that's what I did last week. Why do I do that sometimes? Because so far the higher-ranked stocks perform better than the lower-ranked stocks. More on that in the next few slides. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. So historically, what I'm finding is that on average, the stocks ranked 1 through 5 have been outperforming the stocks in positions 6 through 10 on average. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. However, the downside is this reduces portfolio diversification by a lot. But some investors are comfortable with a more concentrated portfolio. So far, investing in only the stocks ranked 1 through 5 would have improved annual returns by 55.9%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation of the portfolio is 4% or greater, like Microsoft last week, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacation, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's return, especially if the company is in the top 5 that week's ranking, as mentioned in the bullet point 1. So far, by not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 21.9%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G annuities, 119% gain in 12 months, and Repositrax's 97% gain in the same time frame. On average, they have not performed quite as well as the dividend growers in the portfolios. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers in the portfolio is because many of the under-the-radar dividend stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. So it means you're taking on a bit more risk. Number 4, sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts the dividend, or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this fourth strategy is the most difficult of these strategies to implement because you have to implement your own valuation methodology. And some people use just really simple valuation methodologies such as PE ratio. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and that money is automatically invested in their 401k. Now, when I started investing in the dividend growth stock portfolio for a classroom project, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Plus, doing it weekly adds more portfolio diversification. So if one doesn't mind getting less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality ranking of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at the stocks that have raised their dividends recently in our portfolios. The holy grail of investing, as I said before, of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Last week, Clear Secure raised its dividend by a whopping 25%. Visa boosted its dividend by 13.5%. AbbVie increased theirs by 5.8%, and Entergy's dividend was raised by 5%. The last 22 dividend increases for the portfolio have an average of 10.8%. This slide shows stocks in our portfolios that have chosen to split their stocks. Now, stock splits don't mean anything good or bad. But since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. As of last Friday, a record 6 stocks comprised 4% or more of the portfolio, with MasterCard moving up to the top spot. Microsoft lost its top position as tech stocks took a beating last week. Remember, our goal is to build a conservative and diversified portfolio by limiting the amounts we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of the portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invest in just the top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 100. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious that when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a lot of time was creating the spreadsheet and learning how to use it. It's pretty complicated. Now let's talk about our high-yield dividend-paying stock portfolio. I have had several older students who are close to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual return so far of 30.14%. Since the portfolio has been in existence for nearly 15 months, that return will likely fluctuate up and down a lot more than the return of our dividend growth stock portfolio, which has been in existence for about 2 3/4 years. Currently, the high yield portfolio's dividend yield is 4.23%, but the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be geared more towards investors close to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we have invested to 5.01%. Now, 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 is more greedy. It features stocks paying higher dividend yields but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, meaning both high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 18.19% and has been held for an average of 183.3 days so far, which is an annualized return of 39.52% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annual return that high since stocks historically average about 9 to 10% per year. On this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields, like 10 to 12%, do not have the chance to grow their distributions as fast as a company like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it up between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2, like Bristol-Myers. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. So as you can see, this portfolio is going to be way more concentrated than our dividend growth portfolio, because the dividend growth portfolio invests in 10 different stocks each week, and this invests in 2 sets of 4, of which there could be overlap. As you can see here, this last week with Bristol-Myers, HF Sinclair, and Pfizer. So both strategies going back to this slide, strategy 1 and strategy 2, still only invest in high quality stocks, meaning a quality of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 are Bristol Myers, HF Sinclair, CVS Health, and Pfizer. And the 4 high yield stocks we bought last week while implementing strategy 2 are Bristol Myers, HF Sinclair, PNC Financial, and Pfizer. This week's purchases have an average of 4.8%, with Pfizer coming at the highest with a 5.9% yield. Here's a look at Monday's ratings for competitive advantages, management, and financial health for those same stocks. And on this slide, we see Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that we had recently received, and then invested them in the top 8 stocks for our buy list for the week. As you can see, last week I spread them pretty evenly over all 8 stocks. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this particular portfolio. We're sticking with the original $1,000 investment to see how much we can grow it to. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio but are not in the technology sector. They are in the communication sector. So far, the portfolio has gained 28.7% in 10 months. In comparison, technology ETF with the ticker symbol XLK is up 16.9% over the same time period, and the S&P 500 is up 21.3%. Best performers in the portfolio so far are NVIDIA, 181%, Meta Platform, 65%, SAP, Broadcom, Pure Storage, ServiceNow, and Fortinet. And back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Now, this portfolio can invest in companies that pay a dividend or don't pay a dividend. So this is just tech stocks. Now, I hesitate to call this a portfolio since it is limited to only one sector, but it has been fun to follow. Since this portfolio started, it had outperformed the 2 dividend portfolios over the same time period, until last week, that is. Tech stocks got crushed last week as volatility in tech stocks has become extreme. Once again, showing the advantage of lower volatility strategies such as dividend investing. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio in the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 92.6 days and has produced an average total return of 6.35%. Using Excel's rate function, that's an annualized return of 27.48%. If we'd instead invested our weekly investment into XLK, which is one of the biggest tech ETFs, instead of a 6.35% average, we would get an average return of 2.39% with the same average holding period, which is 9.74% annualized. The portfolio is also outperforming the S&P 500, but remember the volatility is very high, so this portfolio is not for the faint of heart. And if you're comparing the dividend payers in this tech portfolio versus the non-dividend payers, so far the dividend-paying stocks are outperforming the non-dividend-paying stocks. Note that all of these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because many stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratios, etc. But we use the valuation methodologies we discuss in class and may use on all large stocks, whether they pay a dividend or not. The 4 tech stocks last week, according to our ranking, was Adobe, Applied Materials, ASML, and KLA Tencor. So in the comments, let me know if you have any questions. Also, let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatsthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about the complete portfolio holdings. I'll see you again next weekend with a list of stocks we'll have purchased on Monday. See ya.